Good morning. We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching The China Show. I'm David Ingles with Stephen Engel.
Our top stories this morning, Asian stocks rebounding from 3 days of losses as optimism over a Fed rate cut this month outweighs renewed U.S.-China trade tensions.
President Trump threatening to stop imports of Chinese cooking oil over Beijing's refusal to buy U.S. soybeans, but his trade representative still expects ongoing talks to ease the tensions.
Also ahead, China's price data out this hour set to show only a slight pullback of deflationary pressures.
Plus a Bloomberg scoop. Apple is pivoting further away from China with plans to build more devices in Vietnam, including partnerships with BYD. Good morning. So after 3 days of weakness across equity markets, we are seeing some bargain hunters coming in and swooping in. Volumes are still on the lighter side for most of these markets coming online. Taiwan is coming online, and of course within the markets like Taiwan, MediaTek, we're looking at that coming up on your screens. That's an NVIDIA story. Kospi index within that, of course, is Korea Zinc, which has really come up. I think we're looking at declines there. Right. On the dollar gold, you have on the rates agenda today, as Steve was pointing out, we have the Chinese inflation numbers coming out bottom of the hour, plus, of course, his 20-year bond auction. All things equal, of course, markets are paying attention to, flip the page, please, Jay Powell and the likely rate cut coming end of the month. Okay, A50 futures are pointing to the upside and following, of course, us entering a technical correction on the Hang Seng Tech Index. But yeah, we can get to all of this later on, of course.
Yeah, we're going to be talking about this in extensive detail throughout the morning. All right, meanwhile, top global fund managers are gathering in Taipei for this year's Cathay Asset Management Summit. Our co-anchor, Yvonne Man, is there. Yvonne, what's on tap?
Well, Steve, we sort of had a really conversation with the Cathay Financial Holdings president, C.K. Lee, and really talking about the potential for Taiwan to be potentially that next wealth and asset management hub, right? There certainly has been these new pet projects in the southern tip of the island, Kaohsiung, to try to actually, all this newfound wealth from equity markets, this AI boom, to keep that wealth onshore. So they've developed this sort of testing ground in Kaohsiung with looser regulations, new wealth management products, and also looser restrictions around banks to try to at least push for this mission. Cathay Financial Holdings certainly is looking into that as well, and part of it is really kind of moving some of their AUM and assets from its life insurance unit to its asset management arm. That was some of the news that we just broke as well. So the potential is there when it comes to this new wealth. ETFs have certainly been booming as well here, and of course a very strong industrial base, but there are also challenges as well. How do you compete with the likes of Hong Kong and Singapore, which are very well established when it comes to being a financial hub and the tax incentives there? Taiwan has very high taxes, for example. Also, there's still capital controls around the Taiwan dollar as well. We spoke to C.K. Lee about how to overcome some of those hurdles.
For the currency control, somehow this is weakness for Taiwan. For the geopolitical risk, somehow some investors will have concern. But I think this time the most important thing is the deregulation. So through deregulation, you can see we have a lot of new business we can do. Those business actually we try to do, but we cannot do it before. But this time, those deregulation would help a lot.
So we've heard of the so-called, existing silicon shield that Taiwan has, right? Its chip dominance is hopefully strong enough to really kind of convince governments to come to the island's defense in the face of a Chinese invasion. Well, what they're trying to do now is build a financial shield in Taiwan and keeping that money and wealth onshore. We're going to have a great panel coming up here at the Cathay event here. We're going to be joined by the PIMCO chairman, Vice Chairman John Suzinski there. Also from the Cathay site, Chairman Alan Lee, who's going to be joining us with a great conversation about how to navigate around some of the geopolitical issues, headlines, as you guys have been talking about all morning, and of course the shifts that we're seeing across capital markets.
All right, Yvonne, we'll be going back to you throughout the morning. Yvonne Man in Taipei. Now, here's a closer look at what we're also watching today. The Hang Seng Index obviously has been down about 7 consecutive sessions, pairing about 7% of value over the last week or so. And the tech sell-off continued in Hong Kong yesterday, with Alibaba being the biggest drag on the Hang Seng Index, down more than 4%. Yesterday, SMIC, the chip maker, was the biggest percentage faller, down 8.5%. But we'll have to see whether, again, across China and Hong Kong markets, whether the optimism towards a Fed cut looming this autumn will offset that sell-off that we've seen in the Hang Seng and also in China over the last couple of sessions. We're also going to be looking, of course, at that CPI and PPI data, consistent deflation at the factory gate, and whether CPI inflation can, month over month, can kind of moderate a little bit. And again, there is a window open for the next 3 days about money supply and credit numbers coming out of China.
Yep, everything from M1 all the way to M3. And I think Sok Jen, of course, will be joining us bottom of the hour to help us unpack the inflation numbers and give us a preview, of course, of what they expect as far as the credit data is concerned. So on the Hang Seng Index itself, I think we're about 3.5–4% away from the technical correction. I think Hang Seng Tech entered that. Hang Seng China, which is separate, of course, 87.51.94 is not my phone number. That's the level to watch there on the Hang Seng China Index. On the vol gauge as well, we're back to levels here last seen in May. Let's bring in Catherine Nye, of course, who leads our Asia stocks coverage, to help us understand where we are. And are we likely to see, Catherine, good morning to you, continued selling today, or are we going to see a bounce?
Well, this is the million-dollar question,
Yeah.
but I do think that the word reassess and recalibration is really the name of the game right now, right? You've already mentioned some of the positives that we've talked about, right? That you know, the regionally it looks good. People are thinking about the Fed and things like that, and maybe some of the eco data and the assessments or the outlook for the eco data doesn't look as bad as expected, right? But there is, you know, what we thought when we saw on Friday with the rare earths, the sort of the beginning of this renewed tension. What we thought was just going to be a quick resolution looks like it's actually spilling into many different sectors. So there's this kind of thought, I think, right now from investors that it's like we want to carefully buy the dip, which is good, but also, hey, valuations are really high. We've seen all of these gauges and all these stocks kind of, you know, hit multi-year highs, Alibaba doubling this year. There is some room for taking money off the table. So I think people are trying to look for pockets of value still and for places that are still good entry points. But there is lots of jitters, and that means big swings up and down.
How about on the longer-term horizon? Obviously, we have that November 1st deadline for the tariffs and Trump, and there's been a lot more amplified noise coming from both sides and different moves, retaliation from China, now retaliation, at least promised retaliation from Trump. And then you also, even further out, you have the next 5-year plan coming from China that could possibly boost sentiment for stimulus.
Absolutely. I think that the next plenum that's expected to start on Monday, that's really going to be where people are kind of turning their attention, right? Especially with the renewed conflicts that's happening right before that. There's a lot of expectation going to this that they're going to see some extra stimulus that's going to be the support that's needed. So one, if we don't see that, I think there's going to be a lot more downside than upside. And also two, I think that what we've at least understand the way that people are placing their bets right now is that we're not going to see that kind of repeat from April, because people have seen how the game has played, and so therefore they think that this is just a lot of more jockeying to come.
Yeah, building leverage, right, ahead of a possible meeting between Xi and Trump. All right, Bloomberg's Catherine Nye there. To the latest on trade tensions, President Trump says he might stop buying, or the U.S. might stop buying, Chinese cooking oil as retaliation against Beijing's refusal to take American soybeans, which he calls an economically hostile act. In a post on social media, as we just talked about, Trump said the U.S. can produce its own cooking oil. Yeah, and that follows China's move on Tuesday, sanctioning the U.S. units of a South Korean shipping giant. Let's get a latest from our team and bring it. Derek Wallbank, our senior editor out of San Francisco. John Liu is with us as well, our executive editor, of course, here in Hong Kong. Derek, let me start with you. What do we know about these latest announcements specifically coming out of Donald Trump?
Well, look, David, I think that what you have to read for all of these announcements is the idea that the U.S. and China are both sort of ratcheting up pressure in small and reversible ways, right? In immediate things, these are not the world's, these are not things that will end a relationship, but they both do increase tensions ahead of this likely showdown meeting between Trump and Xi on the sidelines of the APEC summit in South Korea here. Donald Trump suggesting that the U.S. Could stop the importation of cooking oil. He is particularly upset about the soybeans thing. That is not just a commodity play. I think it's really important for viewers in Asia to understand that is not just a commodity play. That is a play directly at Donald Trump's own political base. Farmers went heavily for him in every single presidential campaign that he's run, and he feels a certain political indebtedness to them. This move by China has been seen by the White House as an attack on Trump's own supporters, and they are trying to respond in kind. This is, again, not a relationship-ending sort of threat, but the U.S. was a top destination for these exports, and in 2024 imported more of this than ever. So this is also not a small step, but we've seen quite a lot of these leading into this relationship, even as we still see the U.S. Trade Representative Jamieson Greer and others say that they think that this will all work out in the end. Let's see.
Team, just hang on a sec. Let me just mark this very quickly. And not that this is news, but I mean, yeah, we are looking at a new high here on gold prices on the back really of these uncertainties and tensions around trade. And of course, what the Fed has also signaled overnight. So we're looking at gold futures now just a hair of the 4,200 level. Gold spot, of course, is also within shooting distance of that specific level. Just to also mention here, before I bring Steve back in, Goldman Sachs recently had a 4,800 target on gold. SocGen came out, I think it was yesterday or 2 days ago, and up that to 5,000 as far as their projection for gold was concerned.
Wasn't it Jamie Dimon who said it was semi-rational to be adding gold?
Yes.
Yeah, right.
Yeah.
Okay.
There we go.
Let's bring back our panelists, and John Liu up in Beijing, or he's here in Hong Kong, I believe. Yeah. China announcing, obviously, John, sanctions related to shipping and U.S. units of Hanwha shipping, the South Korean giant. How big of an impact will this move have? We know it had impact on the markets yesterday, and then Trump countered with this cooking oil move. How do you read this?
I think the markets reacted the way they did because it was an unexpected ratcheting up of the posturing that we've been getting ahead of these meetings at APEC in South Korea. I think the actual implications are a little hard to see at the moment. There is not that much shipbuilding that happens in the U.S. These 5 entities that were sanctioned by China, these are all entities trying to help the U.S. be able to build more ships to add that capacity. Slowing that down now, I don't think that will affect the outlook for the supply of ships or the trend in shipping around the world. But it does, again, emphasize to markets everywhere that we have a danger of things getting a lot worse before they get better.
Yeah. Hey, Derek, let's get back to you. You know, I just mentioned some of the comments from Jamie Dimon, who mentioned about gold, but he also talked about some of the credit risks in the United States, and he essentially brought up the old cockroach analogy. If you see one, there are probably many others. Is he really ringing the alarm bells about a potential semi-crisis?
Well, I think that this is one of those things where John said it right, and you could make it in a lot of context, right? It might get a little worse before it gets better. You have seen with gold and with some other things a little sort of move towards a hedge trade. At the same point, I would also note that markets are not necessarily positioning themselves for worst case scenario. If I take this back to the U.S.-China analogy here, we do have threats of 100% additional tariffs on every China export to the United States. That would put levels of the U.S.-China tariff at levels that we saw earlier this year that people were warning were effectively sort of like a breakup in trade between the two, and from which both economies swiftly said, actually, we need to go de-escalate this immediately. So if you look at that and you say, okay, that's sort of on the horizon as a worst case scenario, where do you look through the market and find people betting that way? You really don't right now. So I think John's exactly right when he says, that there are a lot of steps here where you're seeing things get a little bit worse before it gets better. But you're also at the same time seeing kind of on the largest possible side a general market consensus that it's going to get better before it gets a lot worse, if that sort of makes sense.
Gents, thank you so much. Our team there, Derek Wallbank and John Liu. Just cutting down to the open of trade here in Hong Kong and Shanghai and Shenzhen. Futures are pointing to a bounce. We did get a bounce this time yesterday, quickly petered out into the close yesterday, so we'll see how long these gains last. Currently, though, 0.4 of 1%, 15 minutes away, the opening bell. This is the China Show. Good morning. Right, welcome back. So for the third time this week, punchy fix out of the PBOC, this one actually crossing the 710. First midpoint below the 7.1 handle. If you go back almost a year, so the first week of November of 2024 was the last time we got a sub-10, 710 fix here. So market's reacting, as you can see. We'll see what this means, of course, going into, I guess, more trade talks and the data that's coming out in terms of the inflation print in about 12 minutes from now. Let's bring in Ken Wong, Asian equity portfolio specialist at Eastspring Investments. Ken, good morning. Nice to see you, mate.
Morning.
We've seen a pullback this week,
Yes.
quite a big one.
Yes.
Expected? Would you buy this dip? Where do we go from here short term?
Yeah, it's widely expected. The fact is that when HSI was close to 27,000, I think a lot of investors were kind of saying, hey, let's take a step back. Let's see where we're at. The fact is that we have Q3 earnings coming out over the next few weeks, so we know specifically where numbers are. And I think more importantly, I think when you look at sort of, especially around the tech sector, the whole AI ecosystem, it's gone up quite a bit. And so that's why I think this was an opportunity for investors to really take some profit and then wait to see what happens next.
Yeah, where are we at then right now as far as that dip? Does it sort of end now as the rest of the region kind of looks at the Fed and say, hey, we might get a couple of cuts?
No, I think a bit of sector rotation. I mean, for us in particular, when we're bottom-up stock picking right now, we're looking at potentially some sector rotations, going back into some of the sectors that has underperformed. If you look at, in particular, look at financials. Financials, especially Chinese financials, have underperformed quite a bit. Over the past few days, we have started to see quite a bit of interest amongst Chinese financial names again. So there is a bit of sector rotation right now to go back into some of the underperformers. And then, of course, wait over the next few weeks to see whether or not, there's going to be more progress in terms of what a deal potentially might be, or, with Xi and Trump potentially meeting, that could potentially lead to some, better prospects as well. So there's going to be a lot of things, that's going to be going on in the next few weeks, and we definitely are going to be monitoring quite closely.
Yeah.
Is it worth, I mean, you mentioned rotation and not simply exiting the market. My question is, in the next 2 weeks, you have not just the Trump meeting.
Yes.
We have the Fed, you have the BOJ, you have the ECB, you have the Bank of Canada, and then, I mean, that's quite a Halloween.
Correct.
For markets to look. So I guess, is it worth adding a lot of risk within the next 2 weeks?
Bit of wait and see, right?
Okay.
And then you also have China's, sort of discussions around the new 5-year plan, right? So that's going to be a very important aspect as well. And so there's going to be a lot of things happening over the next few weeks, which are going to be very important.
So are hopes being built too much into the fact that that 5-year plan could give signals of stimulus? What if they don't?
Again, a lot of times these things don't happen immediately, right? As you know, we need to wait. And so I think it's going to be important to see, even prior to that, what potential policy, sort of boost we might actually get from China, which could help. And I think this is actually what the markets are waiting to see.
But I think a lot of it is going to have to do with how the tone is set with a Xi-Trump summit.
Yes, and then also, is the national team going to be actually going to start buying again? So there's a lot of these actually going to come into play, and so that's why I think a lot of investors right now are waiting to see, because everyone was assuming that we're heading into the fourth quarter, and now we're heading towards the end of the year. Specifically, where are going to be further potential policy support from the Chinese government? Where are potentially going to be, sort of more stimulus to help the markets? And I think a lot of investors are waiting for that at the moment.
Yeah.
You mentioned we're moving into earnings season. I think we just had the U.S. Bank, some of them, of course, overnight. Any specific theme that you're looking out for that might give us, I guess, justify sort of evaluations and
guidance into 2026. So the fact is that we're already kind of a couple more months and we're towards the end of the year.
Right.
I think it's going to be very important to see, so where are we heading, as we approach 2026? Are we going to see potentially increases in capex, which is going to be important, right? The fact is that we haven't, AI aside, right? The fact is that we want to see further push up on capex.
Okay. This is capex outside AI.
Outside AI. The fact is that AI we're seeing obviously quite a bit, and the whole ecosystem has been quite a big benefactor. But other sectors, are we able to potentially see, further push up in capex, which those are going to be important aspects, and that's why we're very closely monitoring in terms of guidance as to kind of what's likely to happen in 2026.
Now, you're an equity strategist, but on the currency markets, if you're seeing this appreciation as kind of guiding that forward, how does that play in?
Currency appreciation actually does help a bit. The fact is that I think China is still very much in a tight, narrow band. The fact is that with a stronger renminbi, the fact is that potentially you might see a bit less capital outflow. With the stronger renminbi, the fact is that more investors might actually want to keep their money onshore as opposed to having it offshore. We've seen when the renminbi is weak, it doesn't really help the onshore markets. And we've seen also as well is that the onshore markets have still underperformed relative to some of the other markets. And the fact is that with the stronger renminbi, that does potentially help, potentially keep some of that capital within China. And that could help, sort of overall capital markets in the near to medium future.
Ken, I want to get your thoughts on this debasement trade. Gold isn't a good example of that. Is that a good or a bad thing, or is that neutral for equity strategies?
A lot of the markets are at all-time highs, right? And the fact is that when you look at valuations, they're very high. Across the board, whether it be in North America, Europe, and some of the markets here in Asia are at all-time highs. That's why this year, not only gold, silver, right? Yeah. Platinum has also been, key commodity assets that a lot of investors are looking into. So what we're seeing is that, investors are taking a bit more of a wait and say, hey, let's take a step back. Let's, given where we are valuation-wise, given where we are market level-wise, let's look at potentially some alternatives as a way to potentially hedge some of the exposures that investors might have right now in the marketplace. And again, the rise that we've seen in gold and silver, has been tremendous. And I don't think anyone in the beginning of this year would have told you that, we're going to see 40, 50, 60% rises in, gold, silver prices. I don't think anyone predicted that. But this is where we are right now. But there seems to be still a bit more room because of some of this uncertainty that's still right now in the marketplace with a couple of valuations.
There we go. A truly golden moment. A fresh record there. Gold futures. Ken, nice to see you. Hi to the team for us. Have a nice day. It's a great day outside. Ken Wong, their Asian equity portfolio specialist at Eastspring Investments. We're going into the open today. Hang Seng Index on your screens very shortly. The strongest fixing in about 11 months or so out of the PBOC. Plenty more ahead. This is the China Show.
And welcome back to the China Show. We are awaiting September inflation, or should I say deflation data coming out of China. CPI expected to be in a deflationary trend for a second consecutive month in September, but it's moderating. And also we're likely to see fairly flat inflation on a month-over-month basis. Is that PPI continue persistent deflation? Dave, this will be the 36th consecutive month of factory gate deflation. If I do my math correctly, 36 months is 3 consecutive years.
Yeah, but Grand Theft Auto is still not out yet. Certainly more than that. But yes, we'll look at this. As the SocGen's coming out, they're talking about, I'm looking at food prices specifically on the back of this. The open is next. This is Bloomberg.
And welcome back. You are, of course, watching the China Show, and the China markets about to open. We're counting down to the open of those markets in China. Inflation data also coming up momentarily, Dave.
Yep, we'll see what that looks like. Broad expectations are a slight relative improvement from the previous month. We'll see what the month-on-month number looks like. We'll see what food prices look like as well, given the recent conversations around progress, mini progress around anti-involution. So we'll find out the numbers in about 15 seconds. So I also just want to mention before we get to those numbers in the open, and I have 10 seconds to do this, the PBOC is coming out in ring-fencing sentiment with the strongest fix in about 11 months or so ahead. And amidst, of course, the re-emerging trade tensions, 2 seconds away the opening bell, 2 seconds away from the inflation print coming out. I have my screens up. Mainland markets are coming online. 0.1% to the upside there. We're also looking at Shenzhen down, well, up about 1/3 of 1%. Let me just have a look at my screen. Not yet. Okay, flip the page, please. Have a look at where we are as far as Hong Kong the open there is concerned.
We got the numbers.
Oh, here we go. Okay, Steve, you want to take?
Yeah, sure.
Go ahead.
So again, the CPI Deflation, 0.3%. We were expecting a consensus survey of 0.2%. So it's slightly better than the previous months. So we're talking September numbers. August was down 0.4%. So it's a slight improvement, if you will, but still in deflation for CPI. With our next guest, we'll talk a little bit what the reasons why and food inflation and the like. But factory gate deflation persists, smack in line with the survey of down 2.3%, following the previous 2.9%. So 3 straight years of factory gate deflation.
Yeah, okay, let's get instant reaction. And joining us here on set out of SocGen is Wei Yao, APAC head of research and chief economist there. So, yeah, Steve was pointing out, nice to see you, by the way, good morning.
Yeah.
Negative 2.3 on PPI, negative 3.3 on CPI. Just your initial take, without obviously having the benefit of looking at the underneath the hood here.
Right, so it just shows how entrenched the deflationary pressure is still there, right? You can see the system is stabilizing with different policies, especially on the PPI. The anti-evolution is reflationary policy, but it's a very selective, very slow reflation policy. So, and it's fighting against all the downward force, still coming from the housing, still coming from the weaker consumption, and still coming from potentially even weaker exports. So I think this is somewhat still expected. Yeah.
So when you drill down into the news and the numbers after you leave the studio here, what are you going to be looking at? Are you going to be looking at the energy prices and food, obviously, that are normal drivers of this indicator, but what's going to be standing out for you?
Well, I think, the food is a critical component. Actually, you could see downward pressure, deflationary forces even in food. But also, I guess, for CPI, what's also equally important is the core, right, the service part. Because now we know that, the goods deflationary probably going to persist for some time because of the excess supply almost everywhere. Then the question is, can China find another engine of demand and, push for service up, which will be very critical for the labor market and wage?
You mentioned anti-involution, selective focus. Do you see them being able to broaden that out? And if so, in what form could that come?
Yeah. So if we're talking about anti-evolution in terms of the supply side measures, right, talking about cutting capacity, this kind of measure actually is not really good for the growth in the near term. Right. So this is why they have to be selective. They have to choose the battles. They can't just do it every sector and go for it unless they're also willing to do a big demand stimulus at the same time. Right. So given their big constraint on it's a self-constraint on the demand stimulus, they also cannot do too fast supply side reform. So unfortunately, it's just limited.
How much of a priority do you think it will be as the top officials meet in Beijing and come up with the next 5-year plan? How high on the agenda is anti-involution as well as the consistent, persistent deflation?
Yeah, I definitely think it's going to be a very critical topic for them. I think, there are many reasons to worry about deflation as a political regime, right? But the big one is actually you're going to run out of fiscal resources. You can't have local government running out of, resources to manage the economy and the country and the political machine. So I think, the question in the 5-year plan will be how they balance between the anti-evolution with the continuous drive for innovation technology, right? So I think, my focus would be, how they rephrase, the approach for innovation and technology as in, okay, we need to be more selective rather than, going for just capacity expansion.
I want to get your thoughts on, so it looks like the two presidents are still going to meet. Obviously, we don't know what they'll be able to agree on. But in terms of economic backstops or insurance policies, what further stimulus do you think is being prepared, if any, in the event things don't go that way?
Right. So just look at what we have got, right? So what we have got is more investment actually recently from the policy bank funding. It shows that they're still much better at investment than consumption. What we're still missing and been waiting for is more consumption. Right. So I guess if we do have further deceleration or deterioration in the relationship, then the consumption will be the cards they'll have to play, at least bit more. Yeah.
But they need more, right? Because they've done some rebates, they've done some obviously trade-in programs with white goods. But again, I think households are still, despite some of these moves by the government, holding on and waiting it out. You don't want to catch that falling knife if prices continue to go down.
Yeah, I mean, it's very understandable. I mean, the big one is the job market is not doing well, right? So how would anyone, just open the wallet and spend a lot? The subsidies are good. People like discounts, sure. But even the discounts, it's so limited in terms of scope. They can definitely widen the scope. And I hope it's going to be widened to services at some point, because you look at all the traveling data, people do want to go out experience, right? But maybe not so much buying goods anymore. It's also shifting consumption pattern. So I think, all these kind of measures will come one day, yeah.
Well, part of services is property as well. What are they getting? What can they do to put continued floor on the property?
For people, well, the property is a bit unfortunate topic. It seems that they're sort of half giving up on that. It seems that the property is, at least for a lot of cities, is just waiting for the bottom. But for the big city, I do think given the supply-demand balance is actually better, we're not too far from that bottom.
Can they lean on the exports pillar, because the recent trade numbers look decently good?
Yeah.
Are we underappreciating the growth that comes from exports even further?
We do think that the export strength is not just from transshipping or just changing the trade direct destination. It is actually a very big part is actually China, because China is part of the electronics and computer supply chain that fuels into the AI boom. Right. So this part of demand may continue to be strong. So actually, we're not so worried about exports. It will be slow down, but it's not going to be falling off a cliff. But I don't think the policymaker can lean further against it. It's because ultimately the demand is not up to them.
The AI trade is an interesting one in China.
Yeah.
Every time I'm there, and I'll be back there in China and Beijing on Friday, the officials are continually talking about AI. Are they really hitching their wagon to the future innovation that is going to come, and that kind of investment going towards the unforeseen future of AI, as opposed to really correcting the fundamentals of the old economy, whether that's the manufacturing of EVs that we've seen, the race to the bottom there, and in other sectors?
Well, I think AI is going to be positive for growth and productivity. Right? I think that's like everyone kind of recognize it. They recognize it. Of course, then you would worry about labor market at some point, how they can create more jobs, even given that it's already a problem. But that's
the unintended consequence.
Yeah, that's the unintended consequence. But from the perspective of the Chinese policymaker is that we first need to get that. We can, we need to be in this race. We need to be, at the top of this race. Then we will see what happens. Yeah.
How are you? I'm going to ask you a markets question, but I'm curious how you're looking at it from an economist perspective, because, well, that's it. When you look at the bullish sentiment, what do you think of?
Well, I think it's one related to all these AI story.
Okay.
Right. China is maybe only second to the U.S. on this, so you don't see anywhere else right now, in this race very strongly. And second, it is, I think, I still believe there, the policymakers will do the right thing before too late, will step up on the policy, which we also believe, because it's really something they have to do. They can't afford to see economy slowing too much. So it's the policy plus the technology story, then plus the selective story in terms of the anti-evolution, different impact on different sectors. Yeah.
How do you see November 1st as a possible real turning point? That's when tariffs would possibly go back to their high numbers. The truce ends. If this rhetoric that we're hearing of late from the Chinese and from the White House about finding certain leverage for any potential trade deal, what if it all falls apart?
Well, first we think the chance of falling apart is not a main scenario, because the logic behind the whole thing is that the high tariff didn't work very well in terms of pushing China back on certain things. And why would you expect it to work the second time?
Yeah.
Right. The other thing is that, yes, as you pointed out, they all want to have something to prevent the worst. But if you look at, in terms of the trade, the leverage the U.S. has on China, U.S. demand is only less than 10% of China's exports now. Right, so it's actually even a smaller leverage. So
Is there leverage from an economic perspective?
Well, you can always say yes, right? But then we discussed as in, okay, China is slowing down, but they haven't done any very big demand-side stimulus, right? So they're holding the cards. So in a way, from the Beijing's perspective, we don't have that much to fear here. So yeah, let's see.
Okay. Well, Halloween's coming up, but that's a
And I'm the Grim Reaper here.
There we go. Wei Ya, thank you so much. Wei Ya, the head of research and chief economist at APAC at SocGen there. Okay, a couple of movers to tell you about. We're about 10 minutes into the session here. This one, of course, substantially higher. Relatively small-ish. Listing today, substantial gains, though, as you can see, 154% to the upside. It certainly helps that it is, of course, in a sector that has done extremely well, which is biopharma as well here in Hong Kong. From that, let's have a look at cooking oil-related stocks. Any reaction there? No, not much reaction. High Carry, Arawana, of course, is one of the big ones. They're listed onshore. And, of course, the other big news, and we'll find out what the reaction will be in Vietnamese markets later on, is really this, I believe our scoop here, that Apple is looking to build, I think, 3 devices now in Vietnam, and BYD is one of the partners there as a final assembly, I believe, of that conversation. This
is a very interesting story to come out right now, especially as Tim Cook is in China right now, right? Sizing up that market right now. Apple pivoting further, we're going to talk about this when we come back from the break, pivoting further away from China with plans to make more devices in Vietnam, some in partnership with BYD. Details on that exclusive report coming up next. This is Bloomberg.
Right, welcome back. We are seeing a bounce. Opening minutes, not a lot, not certainly completely not to reverse completely the losses yesterday, but certainly we have pulled back from the edge, particularly when you look at the Hang Seng China Index, which got extremely close to entering a technical correction. Certainly, by the looks of it today, that doesn't seem like it could happen. Consumer prices came out slightly worse than expectations there, but yeah, we can get to all of this a bit later on as well.
All right, let's check out some of these movers. BYD is obviously in focus, as we just talked about. They're going to possibly be making some of those Apple products in Vietnam as a pivot away from China. Bloomberg learned that Apple is preparing to expand manufacturing in Vietnam as part of its push into the smart home market. Some of these other stocks here, you're looking at Tianma Microelectronics. They're a low-cost LCD panel maker or supplier. And they could be part of this equation as well, rather than Apple's latest display technology. Apparently, these devices in Vietnam would use these lower-cost LCD panels supplied by Tianma. That's why we're looking at that. It's up about 0.1%. For more, let's bring in Bloomberg tech reporter Newly Purnell. So bring us up to date and up to speed on this story. Is this a seismic shift or just a part of a longer-term trend to diversify away from China?
Yeah, a great scoop by our colleague Mark Gurman. He's reported earlier that Apple's working on these 3 new devices for the home. The first time they've created a device like this, we've got a security camera, a home hub, and a tabletop robot. And interestingly, he's reporting we're going to make them all in Vietnam. This would be the first time that they have made a new product in a new category outside of China. Usually they make them first in China and then they expand operations to other countries. And interestingly, the partner, BYD, of course, the Chinese EV maker. I think it really underscores the importance of Vietnam. Apple has already been making other products there. But of course, it is part of this larger strategy, yes, to shift their production for geopolitical risk, for supply chain issues, tariffs away from China to other countries, India notably, Vietnam, Malaysia. But interesting here, details on these products being made in Vietnam and with BYD.
Do we expect the trend to continue?
I think so, and I think that it makes sense. Of course, these new products wouldn't be immune as the current regime stands from tariffs. They'd still be hit with tariffs. I think it's also really interesting to look at the bigger picture for Apple. You know, they really would love to ignite new investor and consumer enthusiasm in their products. You know, they've faced some very high-profile challenges when it comes to getting on the AI bandwagon with Apple Intelligence and other services. People have been wondering how are they going to incorporate some of these new technologies into their products. These would be the first time, as I said, first time making these new kinds of products. And can it bring some of their mojo back? Can it reignite consumers? Of course, they have the new iPhone, but they face challenges all over the world for smartphones. But can they get into these exciting new products, and what will consumers' reactions to that be? So high-profile new launches.
Yeah, one of the three devices there is, Steve was pointing out earlier, an advanced tabletop robot.
With an arm. With a retractable arm.
Right.
What's it supposed to do?
So I think
grab your food.
So I think the idea is, if you think of like the home hub, so if you think maybe like a 7-inch by 7-inch display, the idea is it could be on this articulated arm that could sort of follow you on. So you could do a FaceTime call, or you could use it maybe to control, home appliances, perhaps, play music, movies, that sort of thing. So yeah. Try not to think of it in a dystopian way. I think I would suggest.
I think of everything in a dystopian way.
The wrong person to talk about. There we go. Julie Fernell there, putting some ideas in her head. Our tech reporter there. Okay, let's take it back now to markets. Cathay Financial, says it plans to gradually mandate all of its $220 billion in assets from its life insurance unit to its securities investment trust. That's as the Taiwanese regulator encourages financial institutions to move assets. The Cathay president spoke exclusively to our co-anchor Yvonne Man at their asset management summit taking place in Taipei.
We are very excited about this project because you can see Cathay Financial Holding from the beginning. We utilize, we call dual engine strategy for the group structure. But we feel, suppose we can transfer to be a 3-engine structure, including banking, insurance, and asset management. That should be very, very good. We will take this time, try to transfer the group structure. So we put a lot of efforts, try to build the Cathay site as an asset management platform. So this time the FSC not only encourage a financial institution to develop private banking business, family office business, they also encourage a life insurance company to move their assets and professionals to site. So
how much do you think it could grow in terms of AUM?
Well,
what targets are you set now?
So far, the Cathay site is even around 2 trillion NT dollars. Suppose plus around 6 to 8 trillion NT dollars from Cathay Life and professional. Suddenly, the Cathay site will become a sizable site in the region. So we try to make Cathay site be stronger and bigger, and they are strong enough to manage the local and international third-party assets. This is the very, very, very exciting moment for Cathay Financial Holding.
Yeah, it certainly has its potential, right? But also, Taiwan does have its sort of hurdles that it has to overcome. I mean, for one thing, there's higher taxes here. Yeah. There are capital controls around the Taiwan dollar. Yes. Also, there is geopolitical uncertainty with China as well. Do you think this project counteracts some of those challenges? Well,
actually, for the tax, for the currency control, somehow this is weakness for Taiwan. For the geopolitical risk, somehow some investors will have concern. But I think this time the most important thing is the deregulation. So through deregulation, you can see we have a lot of new business we can do. Those business actually we try to do, but we cannot do it before. But this time, those deregulation would help a lot. You can see so many local and international business in Taiwan. They try to set up operation in the Kaohsiung special zone. So suppose there's no attractiveness, why so many financial institutions rush into the Kaohsiung financial special zone? So I think that you can imagine the government tried to develop the asset management center for more than 20 years. Yeah. But we haven't achieved it. Just you mentioned. Yeah. Several issues we still facing today. But I think this time, because the FSC is very proactive, right, and also encourage all the financial institutions to participate. And I think actually at least Financial Supervisor Commission had earned the confidence and the admission from the financial institution and public.
And that was Cathay Financial Holdings President Chang-Ken speaking to Yvonne Man exclusively in Taipei. Now, if you're a subscriber and want to rewatch that interview, you can via our interactive TV function, TV Go. You can also become part of the conversation by sending us instant messages. Do so. This is Bloomberg. We'll be right back. And welcome back to the China Show. Some corporate stories we're tracking today. Autonomous driving firms Pony AI and WeRide have secured approval from China's securities regulator to list shares in Hong Kong. Each company can list about 102 million shares. Both are ready to be listed in the U.S., but join a growing group of Chinese companies seeking secondary listings here in Hong Kong, which is on track to record its highest IPO proceeds in 4 years. And AMD shares rose in New York after the company landed a major chip order from Oracle. It says Oracle will put 50,000 of its forthcoming MI450 semiconductors into data centers from the third quarter of 2026. The order comes as AMD works to become a credible alternative to NVIDIA, of course, the dominant provider of AI processors.
All right, let's have a look at the currency markets. And I think the big event this hour was that very, very strong fix coming out of the PBOC. It was north of 300 pips, stronger than expected. We had a fix that was, as you can see on your screens, below 710 for the first time in almost a year. The currencies reacted. That's the offshore rate. I'm looking also at the onshore rate, which we'll show you a bit later on as well. Also seeing the adjustment, given that adjustment in the midpoint. Equity markets are doing well after, I think, 3 days of losses across the region. Yep. More in the market story coming up next. This is the China Show. Right, welcome back. You're watching the China Show. We're crossing it over now to the Cathay Asset Management Summit taking place in Taipei, where our co-anchor Yvonne Man is currently moderating this conversation on, well, this creatively labeled navigating geopolitical shifts and market evolution. Let's listen in.
But increasingly, and you're seeing this with what's evolving in Japan, you've seen it with Mark Carney in Canada, you see it with not with Keir Starmer, but you see it on the continent, you see a lot of minority-led governments, which makes decision-making much more complicated.
Having said that, we're talking about, you're just saying how the world is much more complex. It's much more transactional, even when you're seeing it from, leaders and governments. Let's talk about this balance of power. It seems to be really being redefined now. You talk about the strategic economic rivalry between the U.S. and China. You have this realignment with the Middle East. Obviously, the emergence of the global South is quite interesting as well. And of course, more influence in these emerging market blocks as well. How do you see this kind of new world order evolving, John?
Well, in our last secular forum, where we look at the world over a 5-year period, we talk about the decline of American exceptionalism, and we do believe that. What's interesting right now is, China has been extraordinary. We're now on the 15th 5-year plan. Okay, so China is a very well organized economy. It's the second largest economy in the world, and they really, particularly now in terms of technology and green technology, they're brilliant. For the first time, you have an American president who actually has a strategy. He spent the previous year before running putting in place his cabinet and all the things he was going to do. And whether you like it or not, and I say it again, whether you like it or not, he's doing everything he said he's doing. So for the first time, you have the two largest economies, you have two leaders, both of whom have very strong views about their countries, their economies, and it's all, the area that's going to become the great tension, and you see this with Friday's announcement on specialty minerals, because specialty minerals, of course, is the major input for semiconductor chips and AI and digital. The real conflict and the real challenge is going to be how the two countries work together on AI and the applications of AI as it relates to a number of things, including the weaponization of AI.
Alan, maybe you can chime in and talk a little bit more. These structural sort of changes that we're seeing, how do you think that changes the fundamentals of capital markets?
谢谢。Chang也提到了非常多全球关于一些地缘政治、关税、贸易谈判上面。我想从全球的一些我想补充几点，就是从全球宏观来看的话，大家都很清楚了，全球化已经式微了，取而代之的是本土化跟区域化。另外，政府的角色，刚Chang也提到了，那我想补充的东西，在很多已开发国家，政府的角色已经从小政府变成一个大的政府。那意味着说，政府会出来主导一些投资，特别在国家安全的投资。同时，政府也在鼓励甚至带领的民间企业做相关的一些策略产业的一些投资，包括刚这样提到的 AI、能源等等、战略物资等等。那在经济环境上面来看的话，我想在这个
Right. We will leave it there for now. Of course, that was our co-anchor Yvonne Man in Taipei. And Cathay, of course, is the summit that's taking place as they navigate the shifting geopolitical risks, of course. We just heard there from the PIMCO vice chair. We're also hearing from other the panelists there. I think my last understanding of what they just mentioned, there's the shifting global tide. We're looking at now 4 positions and the shifting conversations to bigger, I believe I heard bigger government. We'll dip into that a bit later on once we have a better understanding of what's taking place there. Right. In the meantime, though, as far as markets go, a couple of stories to tell you about, right? So number one is this very strong reference rate, very strong fixing coming out of the PBOC. This is actually the fixing that tracks the fixing going back to, as you can see, November of last year. Dollar China is adjusting lower. It's worth pointing out that we are coming off the highs of the day on the Chinese currency strength. Number two is gold in the last hour, in fact, almost exactly 60 minutes ago, hitting a fresh high here of very near, as you can see, 4,200. That's coming up on your screens, futures and spot. Gold plays are playing out quite nicely. You have Zijin Gold. You have, of course, Chow Tai Fook is up, one of the best performers today in the Hong Kong markets, 3% to the upside. And broadly speaking, is really a day where we are getting a rebound across risk assets. Today we're up 1.2. We're looking at likes of Taiwan, for example, up about 1%. Japan also as well. And certainly worth watching today will be the 20-year bond auction in Japan. It's the first, I believe, long-dated one that they're going to get out. We'll see what demand looks like given just the uncertainty over who eventually will take the majority there as far as the Japanese politics are concerned. Apart from that, we're also coming off the inflation print about 35 minutes ago, and I'm just looking at my stats here, Steve. Yeah. The headline inflation actually coming in at negative 0.3, which was actually at the lowest end of the forecast. Didn't come in below the lowest end, but it was actually towards the low end of forecast here.
Yeah, I mean, there was a little bit of food price inflation because coming from August where prices were down 0.4%. So it was a little bit worse than the survey. We were expecting a little bit more food price inflation at 0.2 was the survey. But again, it's pretty much confirming the trend of CPI deflationary trend. This is the second consecutive month we've seen falling prices on the consumer front. If you look over at PPI, the factory gate deflation, 36 consecutive months now. That is 3 straight years of factory gate deflation. And the problem is, again, you have falling prices in a lot of, price wars, I should say, in a lot of key goods, namely EVs and the like. And you just simply don't have that demand from households. They're waiting this out to see. So again, household wealth is down across China because of the property problems. And again, there has not been a deluge of stimulus to boost that consumer support. At least it hasn't trickled down into that inflationary.
Yeah, not a big bazooka in aggregate. You are getting some discounts, some coupons, a little bit of handouts as far as, to your point, right? You know, when you get a lot of the consumer support, that is actually, if you think about it, that is counter-inflation because that does tend to drive prices down. And I think the interesting bit, too, we were speaking with Wei Yao out of SocGen earlier on, and right, so one of the things she mentions that there's this, on the PPI front, anti-involution, right, there's this trade-off that authorities are cognizant of, right? Yeah. The more you do on anti-involution, the more you take away from short-term growth. Right. And without that backstop, to your point of demand, there doesn't seem to be anything there that is able to then lift the other side of the equation. Now, all that being said, what is the outlook for anti-involution campaign? What is the outlook for inflation? Just have a listen to Chang-Ken and how she actually phrased that, the latest price numbers as well.
Right.
It just shows how entrenched the deflationary pressure is still there, right? You can see the system is stabilizing with different policies, especially on the PPI. The anti-evolution is reflationary policy, but it's a very selective, very slow reflation policy. So, and it's fighting against all the downward force, still coming from the housing, still coming from the weaker consumption, and still coming from potentially even weaker exports. So I think this is somewhat still expected.
There we go. That was Wei Yao, who joined us earlier here on set, out at Chang-Ken, of course. And we'll take a short break. We'll be back in a couple of minutes.
And welcome back. You are watching the China Show, and a beautiful day in Hong Kong today. And a look at how the Hang Seng Index, well, here is the H-share. This is the HSCEI, up about 1.5%. These are of course, the 8 shares, mainland Chinese shares. And, we've been testing down to the 9,000, below 9,000 level over the last couple of sessions here, but it hasn't been below 9,000 since, I think, September 4th, so more than a month. And so it's found a little bit of a bottom, at least for the opening hour or so of trade. 8 shares up. The Hang Seng Index also up 1.47% after 7 consecutive days of closing down. So we had lost about 7% over the last 7 sessions. So I'm not saying, Dave, that we're ready to call the bottom to this, but a little bit of a bounce up as the region has been up on expectations that we could get 1, maybe 2 cuts from the Fed. So that is boosting a little bit of sentiment right now.
Yeah, he was very clear overnight, the Fed chair, of course, in his flagging of that rate cut that's coming up as well. I mean, just to add to some numbers that Steve was just pointing out there, right? So we were very close to entering a technical correction on the Hang Seng China Index. So the high that we hit was 97.2438, and the low we were looking at below that, we were going to get a correction 87.5194. I think my producers are about to show you that level at the bottom of the screens, but that is a level to watch to the downside if we close below that level. It doesn't seem we'll close below that level today. That would put us into a technical correction, like the Hang Seng Tech Index entered, of course, yesterday. But anyway, Steve, let's get an update here.
Yeah, let's get some top global headlines. President Trump has threatened Hamas with retaliation if the Gaza-based group does not lay down its arms. Trump says disarmament needs to happen within a reasonable period. Meanwhile, Israel says it's limiting aid into Gaza because Hamas has yet to return all the bodies of dead hostages, a key part of the deal that took effect last week. And President Trump has signaled the $20 billion rescue package the U.S. is planning for Argentina may depend on Javier Milei's success in upcoming midterm elections. The comments triggered fresh jitters in local assets with currency swaps intended to help shore up Argentina's peso and calm markets. Trump also says the two governments plan to discuss a potential free trade deal. And the French Prime Minister Le Cornu has offered to help hold off on a new law raising the retirement age in his latest bid to restore political stability. The offer comes as Le Cornu faces threats from opposition parties to topple him in no-confidence votes on Thursday. The opposition Socialist Party said it would only back the government if the pension law was suspended. And the IMF is warning of dim prospects ahead for the global economy with signs of strain from sweeping U.S. tariffs and protectionism. Global growth is so far holding up better than expected, with the fund raising its growth forecast for the year slightly to 3.2%. It says this is largely due to temporary factors, such as the weaker dollar and preloading ahead of the tariffs.
The tariff shock is here, and it is further dimming already weak growth prospects. This is clear even in the U.S. Growth is revised down from last year, the labor market is weakening, and inflation has been revised up and is persistently above target, signs that the economy has been hit by a negative supply shock.
All right, so that's the outlook as far as the macro and growth outlook is concerned. You know, closer maybe to the hearts of markets, quite literally, is this AI trade. So the latest B of A fund manager survey, and just take note, of course, of the dates when that survey was collected. So this was even before most of the declines we've seen recently and before the latest escalation of trade tensions, which was the trigger, was we are now getting a substantially higher percentage of respondents that think when you look at the tech stocks and AI specifically, might be looking at prices a bit too high in that menu.
Yeah, I mean, a little bit of shaky ground for the Mag 7, especially obviously in the U.S. And then we saw some weakness clearly yesterday in Hong Kong with Alibaba, SMIC, and others feeling that pressure as well.
Yeah, and I think Ken Wong, who joined us out of Eastspring earlier on, did acknowledge that, you know, prices can remain very expensive for some time, but all you need is a very low trigger to be able to cascade that into sort of the losses that we're seeing. Now, the most crowded trades, Steve was pointing out, of course, long Mag 7, the short dollar story, long crypto, and a lot of these are related. So far, the only thing, at least for today, that is continuing to give and profit if you're long is gold, right? We can get to that later on. But specifically, when you look at gold prices now reaching this new record about an hour back. Okay, let's get a sense of these markets right now, where we are on the macro side, equities, and everything in between. Winnie Xu is with us right now, also out of Hong Kong. Winnie, so we woke up today with two things. One was, well, I woke up with a headache. Nothing to do with anything I consume. I did not consume any alcohol, just for the record there yesterday. I just didn't sleep well. But so I woke up with a headache. The Hang Seng Tech Index entering a correction, underperformance in U.S.-listed Chinese equities. And the Fed, though, giving us perhaps a positive offset here, Winnie. Well, let me start off with the Fed. What do those comments mean out of Jay Powell mean for risk assets today?
Yeah, so obviously today, when we're looking at finally stocks seeing a bit of a rebound, because like you said, just yesterday, it was a lot of worries around these trade tensions. And at least today, when we're seeing that, there is that path of the rate cuts to come from the Fed, that really at least eased some worries around kind of the broader macro environment, so that there is more room for other central banks to cut, and there is more room for these companies to grow their corporate profits. So overall, that is helping with the risk sentiment. But like you said, we have still these ongoing U.S.-China tensions still keeping investors quite worried. So it's really two sides of things. One, buying the dips. We are seeing investors coming into buying some of these Chinese stocks. But on the other hand, some of the investors are a bit more cautious because how valuations are high and how ahead of the potential meeting between Xi and Trump, there still might be some more negotiations to come.
So, Winnie, what I gathered from what you're saying is this might or could be just a temporary reprieve on the selling, in particular what we've seen in Hong Kong selling off for the last 7 days, because those pressures are still there in the market. So there might be, a temporary floor when we don't really have any particular catalyst unless there's a massive breakthrough really between China and the United States.
Yes, exactly. So far, we are still seeing some of that pressure there. And yes, it's been 3 days of a sell-off and finally a bit of a rebound. But overall, I would say that the height or the key point here is that volatility is really high, right? Because when you look at what happened in the past 2 days, Monday, we started off selling off with a bit of a rebound in the afternoon. Yesterday, we started off in the green, and then things kind of go to the other side, going into the red in the afternoon. So volatility of HSI, you're looking at highest since May. So there is a lot of these news here and there kind of dragging on the sentiment for investors right now. And yes, we're waiting for that catalyst to see if there is that big breakthrough between U.S. and China. But also with that fourth plenum coming up next week is something that investors are really looking forward to for potential further domestic stimulus to come. But interestingly, this time around, when we ask investors if they're shifting their allocations based on what's going on recently, they're saying that not really, because of that overall how they are seeing think actually China this time around might have a stronger negotiation platform for them, and that they have that upper hand this time around. So still more optimism around for Chinese stocks. And like you mentioned just now, the Bank of America survey came out with sentiment around Chinese stocks at its highest since April 2021. So I think that's also another point showing that while overall, people are still quite cautious, longer term, more positive on Chinese equities compared to before.
Okay, yeah, I mean, it's how the tides have really changed, higher and higher lows when you look at some of these charts. Winnie, fantastic. Thank you so much, Winnie Xu there, our equities reporter, just helping outline for us the key themes and what's, frankly, a very slow news day, to be completely upfront with you guys. Okay, let's have a look at gold, shall we? So Shandong Gold actually came out. 9-month net income, that's the range, 84 to 98%. We're down substantially. Maybe sell on the news. It's worth pointing out that the share price is actually up 240% over the last, I think, going back to the lows of the last 12 months or so. So stocks have done very well. We'll talk about gold coming up next, the dollar, and of course this weak dollar story we're seeing across these markets today. Right, welcome back. We'll just take you to some live scenes coming through out of Taiwan, where, of course, as you can see, our co-anchor Yvonne Man is moderating this panel on stage for our Bloomberg clients. You can continue to track that conversation that's live go on your Bloomberg terminals. For us, of course, we'll see Yvonne every day. Maybe not for us. We can see her when she's back. But yes, for you guys, you can dip in on that, of course, as that conversation evolves and progresses. There we go.
All right, let's dip into some of the other stories that we've been following. Billionaire investor Paul Tudor Jones expects the Nasdaq composite to climb higher by the end of the year. However, he told Bloomberg that he's nervous about the concentration risk in U.S. equities, particularly around the so-called Mag 7.
My concerns are I see concentration risk everywhere I look. Well, now we have individual investors with the highest equity allocation they've ever had in the history of the United States, really 4 times that of the rest of the developed world. So I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, again, if you just think about the #1 rule of portfolio management is you want diversification. That's why our founding fathers created us as a democracy, not a monarchy, because you want that contestation of ideas. So I'm nervous when I see concentration virtually in anything. Again, whether it's in the stock market, whether it's the composition of the stock market, who owns the stock market, or the decision-making that's getting made in Washington. It makes me nervous because I don't think in the long run, right? Even if all the decisions that President Trump is making are great, is that going to embolden the next president, who may not make as good of decisions, to do the same thing? So I'll look at that, and again, it raises caution flags for me.
But you're still long stocks right now? You're still long the Nasdaq?
I am. I wouldn't say I'm long at this second. I'm clearly. Again, I think there's such a confluence of possibly negative, possibly positive events. I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
That is Tudor Investment Corporation's Paul Tudor Jones speaking with Bloomberg's Matt Miller.
Yeah, higher in the Nasdaq, and it's interesting because we can juxtapose that with this. We just talked about this, right? The B of A fund manager survey that do think. I think when you look at it on aggregate, things do look expensive, but the expectation is if you ask them would you continue to buy it, they'd probably say yes. still. Not useful how that information is really.
Well, yeah, so investors are in a holding pattern. The news flow seems to be in a holding pattern
Yes,
as well, right?
Yes, we are struggling here. So why don't we have a look at FX markets? Why not? Let's talk about the dollar. So this weakness we're seeing today is really quite, I would say, relatively pronounced relative to what we've seen recently. Maybe a lot of that has to do with this unwind. In fact, back to that fund manager survey, short dollar was one of the most crowded trades out there. We had this very, very strong fix coming out of the PBOC. And coming up, a potential market event, potentially, is this 20-year bond auction. Maybe it's going to give us something to talk about, but we'll be done with shows by that point in time. So the 20-year, not on your screens. Why not? We can talk about it later. There we go. Is coming up in about an hour from now. 270 right now is that yield you see on your screens. And I think the commentary that's come through so far is either way, the current environment does not bode well for demand going into this auction, given this melt-up in longer-dated yields in Japan, given the politics there, Steve.
Yeah, so there's uncertainty right now, obviously, with the LDP election, new prime minister, and just their consistent inflationary issues.
Yeah. Well, we'll see about the new prime minister is the question there,
yes.
too, right? Okay, so far the conversation around the BOJ seems to still be intact. A lot of that, I'll unpack this thought on the other side of this break. We're moving into this wall of Halloween hell in 2 weeks. Plenty more ahead. This is Bloomberg. Spooky.
And welcome back. It's 11:29 a.m. in Tokyo. Japanese markets are going on a break in about a minute. And you can see the Nikkei 225 up about 1.3%. The broader topics also up by the same amount. Overall, across the region, we're seeing equities higher, including here in Hong Kong, which is breaking a string of 7 straight days of losses. Again, some optimism from out of the Fed, maybe a couple of cuts coming by the end of the year. So that's in what has been a fairly a dearth of real market-moving news.
Yeah.
The markets are, trying to find a bottom from some sell-offs over the last couple of days. We also have some headlines coming across. Japan's opposition unlikely to reach agreement on a prime minister today. This, according to the Kyodo News Agency. Kyodo citing opposition party CDP's Secretary General. The heads of Japan's main opposition parties are discussing whether they can close policy gaps and pick a candidate of their own for the new premiership.
I mean, the fact that we're even talking about the opposition and the prime minister in one sentence tells you a lot about the tail risks coming back into this market. I guess next day to watch on your screens is the 21st. That's according to FNN, of course, the next extraordinary dates, which is perhaps a different conversation there. Now, all that being said, I promised you guys a few minutes back that I'm going to be talking about and ranting about Halloween. So here's the thing, right? So in about 2 weeks' time, there's this 48-hour, maybe even closer to 72-hour window of Halloween hell that we're slamming into. So we're going into October 28, 29, 30, and then obviously Halloween. You have a Fed decision, a Bank of Japan decision, ECB, Bank of Canada. Between those meetings, Steve, of course, and the crew will be headed to Korea for this massive conversation. Hopefully that will bear fruit in terms of a deal. So we don't know what's going to happen
Potentially you could be having Xi Jinping and Donald Trump meeting on Halloween, but it looks like it's going to be before, if it's going to happen at all, but most likely it will.
Yeah. I think the point that Ken Wong was making earlier on is the next 2 weeks ahead of that window might lead to more vol across these markets. Don't take that big of a risk. Wait and see how that happens. And of course, November 1st, Steve, I think is when the deadline
for this current truce.
For the current truce.
Yeah.
100% tariffs there. There we go. We're talking cooking oil and everything in between right now. In any case, it's a good time to be in these markets today. It's very quiet. And sometimes we like these pockets of silence given the sort of news flow we've had so far.
Well, silence is said to be the loudest noise.
Yeah. Unless you have tinnitus, which I do, then of course that then becomes your the loudest noise. Okay, you're in my head a little bit too much, guys, physically. Okay, let's talk about rebranding. Let's talk about the luxury segment. Let's talk about Hong Kong. Yeah. You have Hong Kong-based Swire Hotels preparing this rebadge all of its house collective properties under Upper House. That's the brand, of course, the hotel management arm of Swire Properties, also announcing plans for new properties upcoming. You have Bangkok, you have Tokyo, you have places in mainland China. Let's get more with Dean Winter here with us on set. Managing Director at Swire Hotels, joining us exclusively to help us break these news. Congratulations, by the way, on this announcement that you're making.
Thank you so much. Good
so,
to be here.
so tell us, what are you guys doing and why?
Well, it's so much more than a rebrand. I think for us, we've got three distinctive hotels in the Chinese mainland: Chengdu, Shanghai, and of course here in Hong Kong. They've all got a global reputation. We've recently been awarded, four Michelin keys recently, and the Upper House here, of course, is in the top 5 of the world's 50 best hotels. So there's that global recognition that we have. And as we look ahead, we've got 4, as you rightly say, four openings coming up in the next 4 years, 3 hotels and 1 branded residence. So we feel it's a natural evolution for us to unify the hotels under one brand, Upper House Hotels.
What's the real reason for it, though? Because again, you had the opposite house in Beijing. I believe it is closed now.
That's correct.
You have East as well over the Indigo Mall. So you had these different brands. What's the core reason why you feel that you should rebrand under one Upper House? Because you had a different house brands.
Right. That's correct. Well, the East hotels are not changing. They're still there. But the House Collective, as it's really been, the drive has been these upcoming openings and the branded residences in Bangkok. And as we grow, the naming convention is frankly more straightforward if it's called Upper House Hotels. That's really what's been driving it, and we're looking ahead towards this expansion and feel that this is the right time to do it.
How much is it going to cost, this expansion? Have you secured the money for that? What's the ROI looking like?
Well, as the asset-light management company, we don't carry the costs. So I think our biggest cost is time. It takes a long time to get deals signed. It takes a long time to build and open hotels, and we don't see revenues coming in until the hotels open. So for us,
what's the timeline on those properties?
So Shenzhen is our next property. It opens in Q2 2007. That'll be the Upper House Shenzhen, and then Xi'an is in 28. Part of a much larger retail-led Swire Properties development. And then we have a remarkable opportunity in Shibuya in Tokyo, which will open in 2029.
So where is the priority then? It looks like you're going Bangkok and Tokyo in addition to what you just talked about with China, and you're partnering with Norman Foster Partners as well, which have the iconic buildings around Asia. The one over my right shoulder, HSBC, the Cheplakok Airport, the Beijing Capital Airport. So Norman Foster has his fingerprints all over Asia. He's going to be doing your building over Lumpini Park
in Bangkok. That's correct. Yeah. Well, I think to your point about where we're going, I think our strategy is very much from sort of South Korea to Australia, that Asia Pacific corridor. But China, Greater China, Chinese mainland is our backyard. We will always be focused there, and that's why we're looking and excited about Shenzhen and Xi'an. We've also got prospects in Guangzhou and elsewhere in Shanghai with Swire Properties, and elsewhere in the Southeast Asian markets, of course, very interesting. Ho Chi Minh, Singapore, elsewhere in Bangkok for a possible other hotel. So the region is bright, and the Foster building in Bangkok, of course, is beautiful. It's a great location. It's being developed by Swire Properties and a joint venture with a local developer. We're bringing our brand, and hopefully it'll do well.
How different is it to run a sort of residence asset as it compared to hotel, for example? And why are you going into that? Just as a sort of strategy perspective, residences?
Well, I think fundamentally it's people's homes, right? So whereas a hotel, you're there for 2 or 3 days. In a branded residence, it's your home. And I think that's why branded residences have become popular, because there's a high level of trust and integrity. It's a sector that's grown over 200% in the last 10 years, and 79% of those openings were actually hospitality brands, which I think tells you a lot about where hospitality brings value and aspirational value, frankly, to those. But it's very different to a hotel. And it's people's homes. There's a whole amenity program which goes alongside it, and a whole curation of events and so on. Residents will get access to other privileges across the group too. So we've put together an exciting portfolio and proposition for those buyers.
What opportunity does this rebadge give you as far as capitalizing on the trends that are happening right now? In particular, in mainland China, we do know as people hold on to their purses a little tighter, they're going for more experience-oriented stays in hotels. So how does that translate on the mainland to RevPAR, revenue per available room, and how you redesign your offerings?
So we've really saw during COVID how aspirational travelers in the Chinese mainland were looking for different types of experiences away from the popular international brands. And people looked for experiences like we offered in Chengdu at the Temple House, which is a remarkable property. And that's continued for sure. To your point about RevPAR, we've seen demand for rooms grow, both in the Chinese mainland as well as here in Hong Kong. The cadence of average rate is not as good. I think there's sensitivity around willingness to pay. It's a buyer's market at the end of the day, but we've seen demand over last year for room nights, which is encouraging, and we expect that to continue into 2026.
I was going to ask you, and I'm glad you brought up it slightly. I wonder if you could elaborate on that as well. Like, at your price point, is there actually weakness coming through as far as consumption or willingness to consume, share of pocket, all those things?
Yeah, I think probably most recently seen during Golden Week. I mean, it was a remarkable 7 days for Hong Kong and a remarkable period for Chinese tourism as a whole. Yeah. I think it's fair to say that the luxury sector probably didn't do as well as the other hotels in the city and the retail sector. I think there is, to your point, some sensitivity about willingness to spend.
Right.
But I think that going into next year, we are starting to see at this time of the year, which is traditionally peak season, we are seeing rates grow again, which is encouraging, and we'll see that go into January. So yeah, we're optimistic about certainly about occupancy, and according to demand, we'll have to adjust rates accordingly.
Okay. Well, I was going to get to that as well. Has it gotten to a point where you need to be more deliberate around pricing strategy?
Absolutely.
Okay.
I think we've at the end of the day we have a business to run, and it's all very well holding on to average rate, but you've overheads are increasing. That's been a fact that the industry's been dealing with, whether that be utilities or staffing. So margins are under pressure. So we have to fill rooms, and it's a perishable product. We only sell it once.
That's right.
So you can't sit on your hands. So that's I think we've been finding the sweet spot though in terms of occupancy and rate in the last year, and now we back ourselves. Going into this rebranding and with the recognition that we've had, I think we're in a strong place to do well next year.
Are you noticing that too in F&B within your properties?
F&B is a tough game.
Is it tougher?
Yeah, I think certainly since COVID, dining patterns have changed. Right. I think it's expensive to eat out. I think, frankly speaking, going out to eat anywhere is not cheap. And so, yeah, we've seen evening business being difficult to fill restaurants like we used to. Lunch and tea and all day dining is very strong.
Okay.
We have
That's interesting.
We have, and bar business is very strong. I think certainly that sort of social side of F&B is definitely strong. Our bar in the Upper House, for example, does extremely well. But yes, it's certainly F&B. Landlord rents are going up. Cost of labour is going up. It's margins are being squeezed. So then capex and investment into restaurant fit-outs, for etc., is difficult. We are continuing to invest in our restaurants though through ownership, and whether that's in Shanghai or here, we've got plans to do more in F&B, but cautiously with investment.
One last question in Hong Kong. We've seen the tourist flow, to your point that you just alluded to there, this last Golden Week. You've mentioned some of the things you're seeing. I'm wondering what your clients are seeing, the people that you talk to. That's this fantastic property you have just a couple of 100 meters really from where we are right now. How would they describe Hong Kong now? Is Hong Kong back?
It's remarkable, really, because I think people that haven't been here for a while say things like, well, it's never changed. It's like how I remember it. Right. People that are coming for the first time are saying, my goodness, this is a remarkable city. I should have come 10 years ago. So overall, David, it's definitely positive. I think that the events that are happening in town, of course, have really made headlines, and the infrastructure, the facilities that the city offers is only going to make sort of better tension, more what we call red dates, when we can hopefully sell out a bit more. So I think the future looks bright, and our customers are telling us that it's a dynamic city, and Temple Street Market's been rejuvenated. Shopping's still a big thing here, so that's definitely positive.
Fantastic, yeah. Steve and I were just talking about... No, we weren't talking about it. Blackpink is coming, right, Steve?
January.
There we go, Dean. There we go.
According to my daughter, they're coming.
According to your daughter.
According to my kids, too.
There we go. Are they staying? Oh, no, we can talk about that later. I was going to ask if they're staying at Upper House. Dean Winter, fantastic. Thank you so much.
Thank you.
Managing Director at Swire hotels. You can get an insider's guide, and I think we talked about this on the newsletter. Black Pink dates, speaking of red dates, Black Pink dates I want to watch certainly. Our insider's guide to the money and people shaking up the finance hub here in our Hong Kong edition newsletter. It's out every Thursday, so that is, what day is it? Wait, tomorrow. It's coming out tomorrow. Okay, you can sign up via Bloomberg.com/newsletters. Plenty more ahead. This is The China Show. Right, so welcome back. So we're continuing to look into Asia Pacific. Of course, we're doing quite well within the Asia Pacific, and this is the perfect segue for this next segment. We're looking at the Asia angle to this latest Bank of America Fund Manager Survey. Certainly within the Asia Pacific, a couple of key takeaways here. Certainly when you look at growth in China recovering, that's perhaps a view on the economy. As far as market preference, Japan still seems to be Japan is the favorite. And then you have Korea, and then you have China, and then Taiwan. Indo and Thailand remain at the low end as far as sector exposure goes. It's tech in Asia, ex-Japan. When you look at Japan, which is the favored market, the place there are banks, rising rates. And of course, within that, really, very recently, really giving you some alpha, is the semis equipment plays over in Japan. So just some key takeaways that going into the thick of the fourth quarter as things stand. Okay, let's have a look at FX markets right now. So the big news, of course, so far, and it's been a quiet news day, was a fairly strong fixing coming out of the PBOC, sub 710. On a fixing first time in about 11 months and about 2 weeks or so. Bloomberg Dollar Index coming up on your screen. Softer dollar is the story today. That's perhaps also why we're looking at gold on the way up, among other factors lifting gold prices right now. 12.12 right now on the Bloomberg US Dollar Index. Let's bring in David Finnerty, our FX and rate strategist in Singapore, for us. David, the fixings coming out of the PBOC this week have really given us something to talk about more than otherwise. How should we be looking at what the PBOC is doing, leaning into, I guess, uncertainty when it comes to trade tensions?
Yeah, well, certainly the signal, if you look at the fix today, was basically the strongest since November last year. So the PBOC is certainly saying that against this backdrop of US trade tensions, which have been escalating in the last few days, they're certainly signaling that, okay, we're in no hurry to let the yuan weaken. And obviously it can trade within a band. So the fixing just gives an idea of what direction PBOC wants it to go, should we say, what its bias is for. And at the moment, basically you're seeing PBOC saying, look, we're in no hurry to let this currency depreciate certainly rapidly. So they're fighting against this idea that any risk off will weaken the yuan. They're certainly trying to give that idea, look, we're quite comfortable at the moment with it basically staying in a tight range within that band. So certainly they're not weaponizing the yuan in terms of letting it weaken. They're not trying to let that happen at the moment while these trade negotiations are ongoing.
David, Steve Engel here. What do we need to look at as far as the yen at 150.106? It has strengthened a little bit, but again, it still is floating above that 150 handle. Can't get any traction on strength right now, despite, of course, what might happen with the BOJ going forward and tightening interest rates. What should we be looking for right now with the yen?
Yeah, the yen's been very choppy trade. A lot of traders would just call it a chop fest, actually, if we're being honest, because it's been whipping around on the headlines, risk on, risk off. I think at the end of the day, one of the key things to really focus on is what does happen with Takaichi. At the moment, look, she is LDP, leader of LDP. That would normally you'd assume that would be to become prime minister. However, with the coalition trade talks basically breaking up, that now throws that into a question over that. And you have opposition parties now debating whether they'll actually can agree themselves on their own candidate of one of the other parties. If that's the case, then you could see someone else other than Takaichi become prime minister, and more than likely, whoever becomes prime minister under that case will be someone who go, look, this increased stimulus, there'll be not spurring BOJ to hike too quickly. So both those things combined would be a bit of yen weakness. So that's certainly in the background one thing to keep an eye on, I think. Even though Takaichi herself is not like a BOJ hiking fan, I think certainly if she wasn't to win, you think overall that's an even clearer signal to the market that there will be some fiscal stimulus coming, and the rhetoric coming out of whoever the new Prime Minister would be would mostly feel like BOJ don't hike too quickly. Those things combined wouldn't really lead to yen strength. Again, having said that, we look at dollar yen, you've also got to look at the dollar side of the equation and how that plays out with ongoing trade negotiations. But from the yen side of the equation, until we actually know who is Prime Minister, you could see a bit of a choppy trade still ongoing.
Yeah, David, potentially, speaking of the dollar side and rhetoric here, I want to ask you your thoughts on what seem to be very clear signals from Jay Powell that the Fed is likely going, if not cementing a cut, all things considered, and nothing changes, of course, ahead of the October meeting. But there's a chance that that Fed meeting comes within a 24-hour window of a Donald Trump Xi Jinping summit, and I wonder how FX markets should be looking at that risk on the dollar there.
I think at the moment, as far as rate cut, you look at the markets, they're basically going, look, there's 2 rate cuts this year, no matter what happens. Yeah. I think Powell really confirmed that yesterday. He really said, look, even though a lot of data has been delayed, obviously with the government shutdown, he did say, look, he's worried about weakening labour market. So he really signalled, look, that's our focus. So we're going to cut more than likely in October. And really the market's going, given the existing dot plot, has said, look, there's been another cut in December. So I don't think Xi Jinping, US summit with Trump would really swing that too much. I think the markets really said, look, federal bank has spoken, and it's what we think and what we want to hear, which is 2 rate cuts. So that will sort of keep pressure on the dollar. And you're seeing a bit today. You're seeing US yields drift a bit lower, which is helping support this dollar weakness that you're seeing across FX markets today.
David, thank you so much. David Finnerty, our FX and rates strategist in Singapore for us. Weak dollar story, of course, as we go into the thick of the Wednesday session across global markets. Stay with us. Plenty more ahead. This is Bloomberg. Right, welcome back. You're watching the China Show. If winter is in fact coming, we certainly don't feel it yet here in Hong Kong. Markets are looking at this as it pertains to power demand ahead of winter in mainland China, and some of the energy-related names are rising on the back of early signs of rising demand there.
Well, analysts are talking about the possible dual La Nina in the autumn and winter of this year, increasing the probability of a cold winter. In particular, up in the Dongbei, up in the northeast, Liaoning Energy Industry Company. It is. I lived there in 1990. It is cold. Minus 30. I've never felt cold like that. Blessed be the Dongbei, the northeast.
You should meet my ex, though, if you want to make her cold that. But anyway, okay, that's a different conversation.
Yeah, so Shanxi, obviously a big coal region, up 2.5% right now, and China coal up 1.5%.
Yeah, okay, well, somewhere where it is maybe warm and fuzzy as we're looking at the sun. Solar stocks, that's my segue going into this specific part of the market. Optimism over policy support. I mean, this is really a trade that I think is on either day 2 or day 3. Citi's now talking about how maybe more policy support, and I would imagine that might have to do with the fact that maybe you're taking some of the capacity off the table, question mark?
Yeah, it may be related to capping the utilization rate of production capacity to no more than 65%, banning net increment in new capacity and aiming to achieve supply-demand balance in 2026. This according to the Citi analysts.
Okay, and yeah, we'll see if that has another day on Thursday. Very, very quickly before we wrap up the show today, Hang Seng Index is completely different from the picture. You know what? No, let me just take that back. It looked similar to this time yesterday, and then things completely just went downhill in the afternoon session. So far, things do look good.
Yeah, again, we'll have to see how long this reprieve, if you will, of the selling lasts.
Okay, we'll see you all tomorrow. We'll leave you to look at Asia Pacific, also doing quite well this Wednesday. That's it from us here on The China Show.